Hello, my name is Michael Swanson. I run the website WallStreetWindow.com, and I run a private group for high net worth investors and institutional investors called Power Investor. Now, over the past couple weeks, we have seen some wild moves in financial markets all over the world. The stock market of China has now crashed 30% off of its highs. And the stock market of Greece, the entire stock exchange, closed a week ago and is still closed as I'm doing this video, and no one knows exactly when it's going to open back up. Now, the stock market in the United States has also gone through a bout of market volatility as the Dow and the S&P 500 both briefly went below their 200-day moving averages and then bounced last Thursday and went up on Friday. And hopefully they'll continue to bounce as we go into this month's earnings season. But cracks in the United States stock market have appeared due to this recent drop. On Wednesday, 90% of the volume on the New York Stock Exchange hit the sell side as the orders hit the bid. And the VIX, which measures stock market volatility, went up 20%. Now, inside the stock market, most stocks are actually acting worse, and most trading patterns that worked in the past couple years are no longer working. What is going on, though, is an invisible big money shift that's going to create new sustainable trends to the upside. However, most people are not aware of what's going on because all they're paying attention to are the stock market averages. They're not even seeing what's going on inside the stock market, understanding the changes that are taking place. Let me show you something. As of Thursday's close, over 60% of the stocks on the New York Stock Exchange are trading below their 200-day moving averages. This weakness in the internals of the U.S. stock market is not something that just started this month. It actually began a year ago, last summer. As you can see, that's when the internals of the market peaked out and started to diverge away from the market averages. Now, they took a tumble during last year's October market drop, then they jumped back up into Thanksgiving, but have been lagging the market ever since. Then, when the S&P 500 last peaked out in this past May, the internals then began to collapse. This disintegration in the internals of the market is a textbook characteristic of a stage 3 topping pattern that will lead to a new bear market. You see, all financial markets move in cycles. You have a stage 1 basing phase, a stage 2 bull market, a stage 3 topping market, and then a stage 4 bear market. The stage 3 phase acts as a transition period that comes at the very end of a bull market phase and then leads to a devastating bear market drop. What happens is during a stage 3 phase, you see the market averages continue to seem to act okay while the internals of the market deteriorate. What is happening is that the market averages are being helped by a few stocks that are still going up, while most of everything else inside the stock market rolls over and lags and goes into bear markets. By the end of the stage 3 top, the internals disintegrate. We last saw this happen in 2007, and it is happening now. Of course, the obvious implication for this is that the stock market is going to go into a bear market, and most stocks, generally speaking, are going to decline. That means people who do not adapt and adjust right now to that future reality will lose money when the full bear attack really gets going. However, I want to talk to you about how you can actually make money from this. Because what the stage 3 topping process represents isn't simply a new bear market coming. It also represents a money shift out of stocks and into new sectors and new asset classes that will go up as the stock market falls and go up most likely for the next couple years, because most bull markets last for 2 to 5 years. Now, I've got to emphasize, it's just going to be a few things that go up. But what the stage 3 topping process represents is the beginning of new dominant trends that will continue and will last for a very long time. What that means is that these next few weeks are critical moments for you and for me, for both of us, to make changes in our portfolios, to position ourselves to not only escape bear attacks, but to actually profit and make money from the few things that will go up. Let me show you what I mean. In the months of March and April of 2000, the NASDAQ completed a stage 3 top as money started to rapidly begin to shift out of the US stock market. However, what you may not know is that money began to flow into a few select sectors during that exact moment, during those months, and those sectors then went up for years. These were all defensive sectors that had been in bear markets for a long time, and then they turned up into a new bull market just as the NASDAQ stage 3 topping process completed itself. Take a look at this stock. This red line on this chart is Philip Morris. It had been in a bear market for years, and then in March of 2000 it began to hold up against the US stock market. The black line behind it is the NASDAQ, and the black line on the bottom of this chart is the relative strength plot of Philip Morris and the S&P 500. This line divides the price of Philip Morris with the price of the S&P 500, so it goes down when the price of MO performs worse than the S&P 500, and it goes up when it performs better. You can see that Philip Morris made a bottom in February 2000 and went into a very short stage 1 basing period. It did this just as the US stock market rolled over into a bear market and completed a stage 3 base, and then went on in a decline for several years. It was a total disaster for tech stocks. You know that. But what people could have done is sold the tech and bought a few things that then went up. You can see how the relative strength line went sideways during this period and clearly turned up in April and rose for the rest of the year. The action in the relative strength line as the US stock market dropped showed that money was flowing into Philip Morris. And Philip Morris began a bull market that lasted for years, as most people just held on to what they already owned and lost money, or tried to trade over and over and over again the crazy tech stocks when they could have just bought Philip Morris. And Philip Morris was not the only stock that did this. This is a chart of utility company Duke Energy. You can see it did the exact same thing that Philip Morris did in 2000 as the stock market rolled over. What was going on was that money was escaping from the risky and highly valued tech sector and going into perceived safe havens of the few stocks that were super cheap and were paying big dividends back in 2000. Now take a look at this. This is Redwood Trust, which is a real estate investment trust. It did the same thing too. You see, it was tobacco stocks, utility stocks, and REITs as a whole that did this. It wasn't just these three stocks, but these entire sectors. Now, in 2007, it was U.S. Treasury bonds that began a new bull market in the months of July and August, just as the U.S. stock market began the final weeks of its stage 3 topping process. In other words, in 2007, as the final top was made in the U.S. stock market, a money shift was taking place out of the U.S. stock market and into bonds that lasted for the next 2 years. People who participated in that money shift actually made money during the crash of 2008. It's all about being in the right ETFs and focusing on them and moving money into them And that's how you can make money, even by being long stocks, long the right things during a bear decline in the overall stock market. Now, I'm not saying to buy any of these stocks or bonds that we've been looking at so far in this video. Don't buy REITs, don't buy utility stocks, don't buy tobacco stocks, don't buy bonds, because these things are not in that position right now that they were in 2007 or 2000. In fact, they're in a position, a drop of the stock market. Bonds are actually acting weaker than the stock market averages. So it's like the opposite situation. But other things are doing better and are displaying these same characteristics. What I want you to take from this video is to learn from this method of using it to figure out where the money's going. And because this stage 3 top is a critical time. How do you do that? Well, you look for what is holding up when the market drops. Because what happens when the stock market drops, like we saw over the past couple weeks, is that there's big selling hitting everything. I mean, when 90% of the volume is down on any given day, that's big selling, you know, and when it's hitting the bid like that, orders are hitting the bid. But when days like that happen or weeks like that happen, and some stuff holds up against all that selling, some of it even goes up, that shows you that's where the money is actually flowing into, and that's what you want to focus on and I want to focus on. Because that's where the new emerging trends are occurring. And there's actually a few things that have broken out into new bull markets over the past couple weeks. And more stuff is going to follow over the coming weeks. Let me show you some more charts to show you what's happening now. Okay, take a look at this. This is CORN, corn. It's an ETF which holds futures contracts for the corn commodity. Now, commodities as a whole have been in a bear market now since 2011, but they're now in a stage 1 base, and some commodities, many commodities, are now holding up against the U.S. stock market drops and are actually breaking out into new bull markets. Now, look at this. See how corn's relative strength line has now shot up, and corn itself, the ETF, has broken through its long-term moving averages to begin a new bull market. If the corn ETF pauses here for a few weeks, it will provide us with a wonderful and safe high reward and low risk entry point for a trade. Now take a look at this ETF. This is WEAT. That's the ETF for the wheat commodity. Displays the exact same pattern as the corn ETF. These ETFs, these two ETFs, are in the exact same position that tobacco stocks, utility stocks, and REITs were in 2000. They're in the exact same position the TLT bond ETF was back in 2007. These ETFs, these chart patterns, are the types of things you want to trade now on the long side of the market. However, I got to tell you, I cannot recommend that you invest in the corn ETF or the wheat ETF to hold them for more than just, let's say, a few months, 3 to 6 months. The reason why is they're backed by futures contracts that cause these individual ETFs to have a decay factor as time goes on, much like the ultra US stock market ETFs do. However, they're great for trades. And there are some ETFs that have broken out, that have very similar charts to these, and do not have these same problems. And I actually bought one of these ETFs the other week, and these are the type of ETFs that you can hold for the next couple years. And there are others like them that I have my eye on. The ETFs that do right can now go up steadily for years, while just about everyone else is going to suffer when the next bear market comes. We are now in what I believe will prove to be one of the most critical months we've ever seen in the financial markets. When we look back on this month a couple years from now, I think we'll see it just as key and critical as the months of March and April 2000 or the August-October period of 2007. that doesn't just represent a stock market top, but the emergence of new trends invisible to most people right now that will actually go up, and the people in that will profit, I believe. And that means that this is the time for you to make changes in your portfolio. This is the time to make sure that you are properly diversified and are limiting your risk exposure to the stock market in general and repositioning funds to things that look like and are starting to go up. That means making sure that you're in the right ETFs and know how to buy the right ETFs. Now, to help you do this, I want you to get my future video updates on the stock market and a couple PDF reports I put together. One is about how to pick out stocks, but another one is about 5 stocks that are widely owned that I think are absolutely doomed. I mean, these are some of the most popular stocks that just about everyone has. I want you to get both of these reports. To do it, just type in 5 doomed stocks in your internet browser, or go below this video and click the link in the description box if you're watching it directly on YouTube. But the easiest thing to do is just type 5 doomed stocks into your browser, opt in to my email alert list, and I'll see you on the other side.